recording, I'm going to be working through the mock test, Jane's Preserves. All right, so let's start by working through the information provided in the scenario. We've got 15 minutes. Jane recently resigned from her job as an auditor to start her own company, Jane's Preserves, making jam and chutney. Jane requires a monthly salary of 42,000 Rand to cover her personal living costs. She will spend 40% of her time working on the production line, performing quality inspections, and the balance of her time will be spent on marketing and administrative activities. Jane's salary has been included in the budget below. All right, so as you know, whilst we are working through the information provided in the scenario, it's important to identify whether a cost is fixed, variable, or semi-variable. So let's start with Jane's salary that we've been given over here. First, it's important to identify the type of company that you are dealing with. We are dealing with a company that makes jam and chutney. So in order to classify a cost as a variable cost, it needs to vary with the number of units manufactured. If the cost does not vary with the number of units manufactured, then it's not a variable cost. So Jane requires a monthly salary of 42,000. That is going to be classified as a fixed cost, because regardless of the number of units that are manufactured during a particular month, her salary is going to be 42,000. It does not vary with the number of units manufactured. Jane entered into a lease agreement for a small factory costing 15,000 Rand per month. All right, so once again, the factory rent is 15,000 Rand a month, regardless of the number of units that are manufactured in any given month. So this is also going to be a fixed cost. She purchased state-of-the-art machinery costing 350,000 Rand, which was financed with a loan from her commercial bank. The machinery will be depreciated over its useful life of 10 years. All right, so just be careful, guys. The cost of the machinery, the 350,000 Rand, that is capital expenditure. It's not a fixed cost or a variable cost that affects profit or loss. It's not an expense, okay? You all know that when she purchases machinery, she's going to debit the machine, or in other words, debit an asset and credit the loan, because we know that this asset is financed with a loan. So you can see we don't have an expense here. So just be careful. This is capital expenditure over here. Okay, there's no expense over there. It's capital expenditure. There's no expense that affects profit or loss. However, when we start depreciating that asset, so the fact that the machine is going to be depreciated over its useful life of 10 years, we then have an expense. And this is going to be classified as a fixed cost because, once again, guys, it does not vary with the number of units manufactured. It's going to be 350,000 Rand divided by 10 years, giving you depreciation of 35,000 Rand per annum, regardless of the number of units manufactured. If they make 50 units or if they make 1,000 units, the depreciation expense is still going to be 35,000. So it's a fixed cost. The production process is automated, but Jane will have to hire 3 full-time employees to operate the machinery and oversee each of the processes. Each employee will be paid 8,000 Rand per month. Okay, so she's going to hire 3 full-time employees, and each employee is going to be paid 8,000 Rand a month. Once again, guys, this is going to be classified as a fixed cost. Regardless of the number of units manufactured in any given month, each employee is receiving a fixed salary of 8,000 Rand. It does not vary with the number of units manufactured. Other fixed manufacturing overheads. Okay, so here you've been specifically told that the cost is fixed. So other fixed manufacturing overheads are expected to be 54,000 Rand for the first year of operation. All right, so that's obviously also a fixed cost. Jane's Preserves will operate for 48 weeks per annum and will close over December so that Jane and her employees can take leave. Jane has correctly calculated that the business needs to sell 61,098 units to break even in the first year. All right, so she's calculated the break-even point. The break-even point in units is 61,098. And please note, guys, you have been specifically told that she's performed this calculation correctly. So you can safely assume that that calculation is correct, and that's the number of units that they need to sell in order to break even. All right, then next you are given an extract from the budget for the first year. So you can see you've got information for both of the products, for jam and for chutney, and then you also have total. And it's always important, guys, whenever you're given a statement of profit or loss and other comprehensive income, to identify whether you are dealing with absorption costing or variable costing. Now, straight up from the layout here, you can see we're taking sales, deducting cost of sales to give us gross profit, which means straight up, I can see that this statement has been prepared using absorption costing. Okay, how do I know that? If the statement was prepared using variable costing, we wouldn't have sales less cost of sales giving us gross profit. Your layout would be different. If we were using variable costing, it would be sales minus all of your variable costs, giving us contribution. We would then deduct all of our fixed costs in order to get profit before tax. So just because of the layout here, I can see we are dealing with absorption costing. And remember, if we are dealing with absorption costing, that means we include both fixed and variable manufacturing costs in the value of inventory. So this complies with IAS 2. Okay, so for sales, you're given more information in note 1. Jane has done some market research and she expects to sell 39,600 jars of jam in the first year. She's uncertain about the demand for chutney, but has estimated the following. So there's a 30% probability that she will sell 23,000 jars of chutney. There's a 50% probability she'll sell 20,500 jars, and there's a 20% probability she'll sell 17,750 jars. All right, so just remember, guys, wherever you're given probabilities like that, what we're going to do is we're going to multiply everything out. So take the number of jars, multiply by the probability. So 30% multiplied by 23,000, 50% multiplied by 20,500, and 20% multiplied by 17,750. And we're going to add all of those together, and that will give us the expected sales. Jam is sold in 250-gram glass jars, and chutney is sold in 400-gram glass jars. Okay, so for jam, 1 unit is equal to 250 grams, and for chutney, 1 unit is equal to 400 grams. Then next, we have information relating to cost of sales. So let's just go and read note 2. When the fruit and vegetables arrive at the factory, they are inspected for quality using color, ripeness, and taste as guides. Produce that passes inspection is then cleaned and chopped into small chunks to prepare for cooking. So then to cook jam, fruit is boiled with sugar and pectin, which is a gelling agent. And to cook chutney, fruit and vegetables are boiled with sugar, vinegar, and various savory spices. When the product reaches the appropriate thickness and taste, it is poured into sterilized jars, vacuum sealed, and labeled. All right, so we just have a bit of information over there relating to the production process so that you can understand how jam and chutney is produced. You're then told that fixed manufacturing overheads are allocated to products based on units manufactured. And this just reinforces what we already said on the previous page. We are using absorption costing. How do I know that we are using absorption costing? Because fixed manufacturing overheads are being allocated to products. So in other words, fixed manufacturing overheads are being included in the value of inventory, which means we are using absorption costing. Okay. And the fixed manufacturing overheads are currently being allocated based on units manufactured. It is company policy to keep 10% of total units produced in inventory at the end of each year. All right, so we know that we are dealing with a new company over here, and you've been given this budget for the first year. So obviously, there won't be any opening inventory in the first year of business. How do we calculate cost of sales over here, guys? We calculate cost of sales by taking opening inventory, which we won't have any opening inventory. It's a new company. It's the first year of business. So there's no opening inventory. We add our production costs, whatever those are, and we deduct closing inventory. And that gives us cost of sales. That's how we calculate cost of sales. So that's how this cost of sales figure over here has been calculated. It's opening inventory plus your production costs minus closing inventory. We don't have opening inventory in this question, so it's just production costs minus closing inventory. Now, your production costs over here, guys, because we are dealing with absorption costing, these production costs over here are going to be semi-variable costs. It will include all of the fixed production costs and also all of the variable production costs. Because we are using absorption costing, both fixed and variable production costs are included in the value of inventory. So your production costs there are semi-variable costs. So obviously at some point in our calculations, we're going to have to split that cost into its fixed and variable portions because we can't work with a semi-variable cost. And now we have also been told that closing inventory is 10% of total production. So it's company policy to keep 10% of units produced in inventory at the end of each year. Let's look at the percentages over here. Production is obviously 100%. That's total production, all of the units that they produce, 100%. They're going to keep 10% of what they produce in closing inventory at the end of the year, which means they are going to sell 90% of what they produce. All right, we then have marketing and administrative costs. Let's go to note 3. Variable marketing and administrative costs are 2% of sales. All right, so this is also a semi-variable cost that we are dealing with over here. The variable portion is 2% of sales, and the balance must obviously be fixed. You then have operating profit minus finance costs, giving you profit before tax. So let's read note 4. The loan from Jane's Commercial Bank bears interest at a rate of 9% per annum and is repayable in 5 equal annual installments comprising of interest and capital. All right, so finance costs for the first year, we know that she financed the state-of-the-art machinery with a loan from her commercial bank. So this is interest on that loan. So the machinery has a cost of $350,000 And we now know that the interest rate on that loan is 9%. So that's obviously the interest in the first year. You can obviously also use the amortization function on your financial calculator, and you'll get the same interest expense over there in the first year. Right, oh, sorry, before we move on. What type of cost is this? Is this a fixed cost, a variable cost, or a semi-variable cost? This is going to be a fixed cost, regardless of the number of units manufactured. It doesn't matter how many units they manufacture. The finance costs in the first year are going to be 31,500 Rand. So that's a fixed cost. Okay, I just want to check we have identified all of the costs so far. Yes. Jane is investigating the use of activity-based costing to allocate fixed manufacturing overheads to products. All right, so she's currently using traditional costing because she's currently allocating fixed manufacturing overheads to products based on units manufactured. So this is just an arbitrary measure. She only has one allocation base that she's using. She'll calculate one allocation rate. So she's currently using traditional costing, and she allocates fixed overheads to her products based on units manufactured. Okay, which means she's going to calculate that allocation rate by taking the budgeted. Remember, this calculation is performed at the beginning of the year, so you won't have the actual cost yet. You need to use the budgeted cost to perform this calculation. So you calculate the allocation rate by taking the budgeted fixed manufacturing overhead. And in this question, you are specifically told that she's allocating the fixed manufacturing overhead to products based on units manufactured. So we'll divide by units manufactured. Now remember, guys, in terms of IAS 2, this should be normal capacity. So whatever normal capacity is, that's what you should be dividing by. However, if normal capacity is not given, remember you can then use budgeted production. Okay, so currently she's allocating fixed manufacturing overheads to products using traditional costing, and she's now investigating the use of activity-based costing. She has identified the following activities and resources planned for each activity. All right, so you can see there's 4 different activities over here: quality inspection, cleaning and chopping, boiling, bottling and labeling. And then for each of the different activity areas, you can see you've been given the area occupied. So quality inspection uses 3 square meters, cleaning and chopping uses 6 square meters, etc. You've also been given the number of employees. So guys, you can see there's a total of 4 employees over here. And so there's 1 on quality inspection, and 1 on cleaning and chopping, 1 on boiling, and 1 on bottling and labeling. Now, if you just go back to the previous page, I specifically told you that Jane is going to spend 40% of her time working on the production line, performing quality inspections. So the 1 employee over here that's working on quality inspection is obviously Jane. And I also told you on the previous page that she is going to hire 3 full-time employees to operate the machinery and oversee each of the processes. So you can see that over here. Here's the 3 employees that she's appointed. Each of them are overseeing and operating the machines in each of the different activity areas. Okay, so that's her 3 full-time employees. Then you can see for the machinery cost, we have the total machinery cost there of 350,000, which we know. We know that the cost of the machinery she purchased is 350,000. That was the capital expenditure. But now you can see what the machinery cost is for each activity. So the machines that are used for cleaning and chopping have a cost of 120,000 Rand. The machines used for boiling have a cost of 130,000 Rand. And the machines used for bottling and labeling have a cost of 100,000 Rand. Produce for jam will be delivered twice a week, and produce for chutney will be delivered once a week. Cleaning and chopping of produce takes 15 hours per order for jam and 20 hours per order for chutney. Jam is cooked or boiled in batches of 10 kilograms and chutney in batches of 16 kilograms. It takes 1 hour to boil each batch of jam and 0.8 hours to boil each batch of chutney. It takes 0.6 hours to bottle and label each batch of jam and 1 hour to bottle and label each batch of chutney. All right, so obviously all of the information that we've been given here right at the end relates to activity-based costing. And that is then all of the information provided in the scenario. So we'll stop here for now.